very good afternoon and welcome. This is Metropole Business Center on Monday. My name is Vincent Odhiambo. Now, in the past 2 weeks, we've seen banks release their 2021 full year performance, a performance that has seen banks reveal huge profits and dividend payout for shareholders for the year under review. This comes following recovery of various sectors across the country. So far, 6 top-tier banks have published their financial performance, posting an average of over 80% growth in net profit. We are joined by Justin Mwangi, an investment analyst at Saiton Investment, on this performance and more. Hi, Justin. How are you?
Hi, good afternoon.
How are you doing?
I'm doing well. Glad to be joining you this afternoon.
Okay, now my first question, what was it that was driving majority of the banks towards this kind of performance?
Thanks for that question. Thanks for having me. I think the greatest thing to note with the 2021 banking sector performance was the fact that a lot of banks reported improved profits. Some of them had even declared quite marginal profits in 2020, but there was a huge improvement in the performance last year, mainly driven by a significant decline in the loan loss provisions, as we saw the operating environment improve significantly because of the ease of the COVID-19 containment measures. We also saw some bit of growth, in most cases organic, in terms of loans increasing by double digits in a number of the banks. The NPL ratio, the asset quality declining. And also we saw deposits increasing. I think another theme was diversification, that is outside the Kenyan market, with KCB, Equity, seeing their subsidiaries outside Kenya at least coming, contributing a huge percentage in terms of the assets as well as in general.
All right. Now, you mentioned something about organic, and if you look at the banking sector, would you say that the banks took advantage of the COVID-19 pandemic, especially when looking at loan loss provisions?
I think that's a very dangerous statement to make, because most banks actually, number one, they did sacrifices in 2020. Some of them required by CBK in terms of just letting go of some of the transaction fees to mobile to and fro. They also mobilized a lot of funds for onward lending to MSMEs, that is the micro and small medium enterprises. Equity was a lot of money, KCB, and most of the banks actually, not just the Tier 1 banks. Then we saw a lot of restructuring in place whereby banks, as provided by the regulator, that is the Central Bank of Kenya, were asked to restructure some of the loans, whereby they call in some of the people taken loans, so they can help them. So in as much as we're talking about huge profits, relatively speaking to 2020, being driven by reduction in loan loss provisions, what the banks were doing is, because of the pandemic, then they expected some underperformance in terms of repayment of loans, and they have to provide some provisioning for that. Otherwise, they may have been reporting losses in 2020 if people actually didn't pay these loans, they didn't restructure, and they didn't make the provision. So that's what the provisions are for. And even last year, in as much as there's a reduction in the provisioning, we are still seeing a lot of the net non-performing loan coverage for most of the banks remaining sufficient. Only 2, I think, of the top 10, Stanbic and KCB, have seen a decline in their NPL coverage ratios. So it's not taking advantage. What they did was they were covering their bases, and because of the improved environment, then what we are seeing is improved performance by most of the banks.
All right. Now, if you look at the performance in last year, it's compared to 2020, a period where we saw the COVID-19 at the highest levels, and a lot of sectors were affected, including the banking sector. What's the projection for this year?
This year, we're likely to see the banking sector remaining resilient still, as we have seen previously. We have seen a lot of resilience in 2020, in as much as there was decline performance. We saw a lot of resilience last year with a huge profit, leading to rallies in share prices. So even this year, with the main challenges being mostly global factors, such as the geopolitical tensions, which eventually affect foreign investor flows and trickle down to actually affecting our economy directly. And the August elections, we still believe the banking sector will remain resilient. Not huge growth in terms of their profits or their balance sheet compared to last year, mostly because last year it was coming from a bit of a low base in 2020. So we're likely to see a bit of slow organic growth this year, and the provisioning levels remain still at the relatively high levels that they are right now. So what banks are hoping for and what we believe will happen is that the credit risk won't increase this year. It is still elevated, but it will probably remain at the same level that it is now.
Oh, all right. Talking about credit risks, we've seen the government, we've seen the CBK approving risk-based kind of lending to majority of borrowers. Is this going to sort of boost the private sector?
It will. What we may see is some of the loans will become the interest charge of some of the loans will increase because of course what risk-based lending means that if you are higher risk, then we're going to charge you a high interest rate to cover for that additional risk that we're taking on board. But also that will mean banks will be more free to lend to people maybe they wouldn't have lent in the previous, for lack of a better phrase, of the interest rate regime. So now, if someone is very risky, then they can account for that additional risk and still loan to them. So it's likely to see that private sector credit will increase, although that means some of the loans may be slightly higher priced.
Okay. Now, let's look back to the dividends that were paid. We've seen some of the banks pay the highest amount in terms of dividends. And this is, sorry about that, this is a comparison with what was happening in 2020 and where some banks shelved dividends in order to stay afloat. Now, looking at now 2022, and you said that the banking sector will continue being resilient, do we see a situation where the investors will get, or shareholders will get dividends?
Yes, because we don't expect significant decline in the performance this year, especially if we compare to 2020, then it's likely that the bank will still keep paying dividends this year. The resiliency will be there, the growth will be there at a minimal level, so there is no reason why bank will still give out dividends this year. If you look at the historical performance before 2020, 2019, going all the way back, banks were still giving dividends on a more or less reliable. It was expected for most of the big banks, especially to give dividends. What then investors were looking at is the dividend this year be high or low, but it always issuing dividends. The exception, with a few exceptions here and there. So I expect the same will be done whereby banks will still give out dividends. A bit at the same level we expect last year, but all this is dependent on some of the downside risks that we may expect to see from the elections or not.
Okay. Now, apart from the elections that we are seeing this year in Kenya and the geopolitical issues that are happening in Ukraine, what are some of the issues or the things that might affect the recovery or the performance of the banking sector?
I would say the first thing is most of the performance of the banking sector is usually a symptom of the economy in general, especially the internal economic factors. So maybe just start internally. We have the elections, of course. That depending on how it goes, historically we have seen some of the elections being peaceful. Others have led to significantly increased credit risk and businesses and the business operating environment being affected. So that's one of the factors. The second thing is, of course, something like the Ukraine factor, the external factors. It will have an effect, but to a reduced level. And the reason I say this is because for most of the big banks, if the effect of the geopolitical tension outside Kenya does not have a direct effect on the common mwananchi who make up majority of the deposit base, then it's unlikely that the banks themselves will be affected to a significant level. So that the way that will affect in terms of inflation, in terms of goods becoming expensive, in terms of businesses not being able to um, being able to provide as much goods and services to the consumer. Of course, that means if things become more expensive, we may see a lot of people are borrowing more so that they meet their daily needs. So that may lead to increased lending. Then another factor will be just the continued recovery, because in as much as a lot of the containment measures have been eased, that is COVID related, we still bear the risk of new variants new variants. We have seen other economies, like China, struggling right now with a lot of COVID infections. Some of the countries in Europe, Germany, are also struggling. So in the event that such another outbreak happens,
We can't hear you. Sorry, we can't hear you. Would you kindly repeat that last part, Justin? Well, those are the downside of technology. That was Justin Mwangi, an investment analyst from Saiton Investment, just giving us more on the performance of the banking sector that has seen the entire sector post an average of over 80% growth in net profits. That marks the end of Business Center. My name is Vincent Odhiambo. Up next is Business News at 1. Don't go away.